Welcome to Retiring Well. I'm your host, Michael Reese, and I'm really excited to have you along for the ride this week. We are talking about asset allocation. I know it doesn't sound very exciting, but think about it this way. You ever talk to a real estate investor, someone who's really good at real estate? What is it they always say? What are the three key things when it comes to real estate? Well, you know what I'm about to say. It's always what? Location, 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 right? Well, I have heard people on Wall Street, some of these bigwigs out there, they say, well, when it comes to investing, it's the same thing, but with investing, it's not location, location, location. It's asset allocation, asset allocation, asset allocation. Well, I think that's fine if you're trying to grow a portfolio. If all you're trying to do is grow a portfolio, yes, asset allocation is an important factor. But I got to tell you this, if you're retired, if you are nearing retirement, it goes a lot deeper than just asset allocation. And it's really important you understand this because you don't want to make mistakes in this area. So make sure you grab a pen and paper, grab a cup of coffee, because Retiring Well starts right here, right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
All right, this week in Chalk Talk, we're going to talk about what effective diversification means and how to achieve effective diversification. What is the goal? The goal is simply this. We want to have higher returns if possible, but more important than higher returns, I mean, if you can get the same returns, that's great, is shrinking the volatility, having more consistency in a portfolio. And I'm going to share with you what people normally do and then how you get effective diversification. So most of the time, think about when you started investing, right? Think back to when you started saving money. You probably did it in a 401k or an IRA, something like that. And all you're trying to do is grow the portfolio. And what you would do is you would find investments, usually mutual funds in your 401k, and they were all focused on, right here, growth. All focused on growth. And another word here is there was some risk involved, right? Because when you put money here, you know in advance. Some years, you are going to make money, right? Some years you're going to make money. In fact, some years you're going to make a lot of money. That's fun, isn't it? But what else do you know? Yeah, some years you're going to lose money. And in fact, if we're honest, some years you're going to lose a lot of money. Now, whenever you put money in this environment, there's always a factor, a four-letter word called time. And by the way, what am I talking about here? Stocks, bonds, mutual funds, that kind of stuff. You need time because hey, I'm going to make money some years, I'm going to lose money some years, but over time, you should do pretty well, right? That's the idea. But then what happens? You get a little older, you get closer to retirement age, and you start thinking, wait a minute, I know in the last 20 years, there's been twice when these accounts have lost half their value. Twice. I know that. And you think, oh man, I need to protect some of my money. And so what do? You take some of your money and put it over here, where it's safe. And what is that? That's at the bank, right? You put it in savings, checking, whatever. And hey, the good news is the money's safe here, but what's the bad news? Yeah, you said it. You don't make any money. Don't make any money. But what are we trying to do at the end of the day? We are trying, you are trying, everybody's trying to find this middle ground, this happy place. And what you're doing is you're saying, I'm going to take some percentage of growth and some percentage of safety. And the idea is that there'll be enough growth from this percentage and enough safety from this percentage where you find that happy medium, right? That's what you're trying to do. Well, At Centennial Wealth Advisory, right there is where we live. That's where we live. We don't try to do everything for all people. Our job is for people who are retired and nearing retirement, it's to live in this space and develop a portfolio that makes the most of that middle ground, right? That middle ground. And in order to do that, to get this effective diversification, you need three things. Okay, there are 3 steps. Here's the first. Number 1, principal protection. The first thing you need to do when you are building an effectively diversified portfolio is you got to decide how much of your money do you want to protect if all heck breaks loose and markets go crazy. How much of your money do you want to make sure doesn't go south? How much you want to make sure you've protected your principal no matter what? Okay, how much of your principal needs to be protected? But I don't want to earn 1% on that. I want to get a little bit better. I'd like to try to get north of 3 if I can, 3, 4, 5, 6 if possible. Second, has to do with your asset allocation, right? Remember at the beginning of the show, what do we say? Real estate, location, asset. Yeah, asset allocation is part of it. But I want to dive a little deeper here. Number 1, when you're putting together a portfolio, you need to dig deep. And here's what I mean by that. It's not just stocks, bonds, mutual funds. Okay, that's not it. I mean, you also want to look at, say, real estate and commodities like gold or oil. You need to be looking at all kinds of different things out there. Maybe you should be looking at covered call writing or maybe you should look at some, catastrophe insurance, whatever it is. You need more than just stocks, bonds, mutual funds. What else? Management style. You need to diversify across management style. Different managers manage money differently. You could have one manager does large company stock, and what they do is they say, these stocks I think are undervalued. And that's how they buy their stocks. Another manager in large company stocks may go with the trend and say, oh, those stocks are up, I'm buying. Oh, now they're down, I'm selling. They own the same stocks a lot of times, but their returns are different. In any given year, one's better than the other. But the key is when you put them together, it's more consistent. More consistent. And then third, I'm going to call it placement. Now, placement means simply this, and this is something a lot of people don't talk about. You need to have the right assets in the right places. You don't put, if you have IRAs and after-tax accounts both, there's certain assets that just work better in IRAs and certain assets that work better in non-qualified. If that makes sense. Placement. And at the end of the day, third, make sure you're looking at alternatives. There are a lot of types of alternatives out there. There's many different types. And depending on your circumstances, some might work better than the other. But they play a role. At the end of the day, when you live in this world and you build effective diversification, then what you're able to do is you're able to make things more consistent, protect yourself better against the down years, still make good money in the up years. And the question you really have to ask yourself is, have you had this conversation with your advisor? And if you're doing it yourself, maybe you're managing your own 401k, your own IRA, I promise you aren't doing this stuff. Probably worth the phone call, probably worth coming in to visit to see if something like this could benefit you with your planning.
You've worked hard for your money and your best is yet to come. You've reached a point where you don't put your money at risk anymore. The road ahead doesn't scare you because your money is secure and working for you. Centennial Wealth Advisory, portfolio stability, tax reduction strategies, lifetime income, financial security in any economy.
Will your retirement vision be your retirement reality? Centennial Wealth Advisory invites you to an eye-opening and exciting event packed with up-to-date, valuable, and important information. Join us for a free presentation with complimentary gourmet dinner and find out what you're missing on these vital topics. What is the suitability versus fiduciary standard of care in the financial services industry? What are the biggest tax traps? What are the hidden costs in mutual funds? Why is getting a second opinion the most important financial decision of your life? And much more. Choose the date and location that works best for you. Thursday, July 13th at the Grand Traverse Resort in Acme, or Wednesday, July 26th at the Inn at Bay Harbor in Petoskey. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit sen-wealth.com to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, making your retirement vision a reality. Call 888-608-5825 today.
Hi, I'm here with Larry Flynn. He's one of the financial advisors at Centennial Wealth. And, Larry, a lot of folks, as they're watching the show, we're asking them to give us a call. Come on in and visit with you and the other guys here at the firm. And I'm sure they're wondering, well, gosh, if I call, what's going to happen? What's that like? I'm sure there's some uncertainty out there. What happens when somebody calls to come visit with you and the guys?
Well, the first thing happens, Mike, is if they make a call, we have somebody from our office reach out to them and basically try to spend about 10-15 minutes with them on the phone just to try to get to understand, what are they trying to accomplish, what do they want to expect when they come in to visit with us.
Okay, like what kind of questions they have, what they're trying to, and I'm sure a lot of folks, they're just trying to get maybe a second set of eyes or a second opinion on things, right?
That's right.
So they call up, someone reaches out, they get some information so that, so I guess essentially you can be better prepared for them when they come in, right?
Well, exactly. Before we want to meet with them, a lot of these people want a risk analysis, they want a fee analysis, they really want, again, that second opinion on what they have. So we might ask them to send some information ahead of time so we can make that first meeting very productive.
Well, of course, because we don't want to waste their time, and you want to make the best use of your time. So maybe by being prepared, sure, right, you can make for a good meeting. So here we are. They come on into the office. I know Pat meets them up front usually, or maybe they're in Petoskey or Gaylord. What kind of things are you talking about? What types of analyses are you usually doing for people? What kind of areas are people finding these conversations to be of greatest value?
Well, Mike, the first thing we do when we sit down with somebody is we really want to know what their story is, where they came from, what they're trying to accomplish, what are their dreams now that they're either nearing retirement or getting in retirement. Right. These are important before we even get into any other discussions because we want to know where they're coming from.
Well, yeah, you got to know where they're from and what they're trying to get to before you mess around with any planning, right?
That's right.
And so once you get through that, what are some of the things that you find yourselves typically talking about with the folks that come visit?
Well, the most important conversation, of course, is how do they feel about investing in the first place? Before we even talk about anything, how much risk are they willing to live with? How much are they willing to lose in just a given year? We saw so many people, didn't we, after 2008? They had that conversation with the advisor. They put them in a conservative portfolio, and the people lost 30-40% and had no clue they were taking that kind of risk on. We're not going to let that happen.
So basically, you're trying to help learn about their situation, learn what they're trying to accomplish, give them a full analysis to make sure that they're on target, and if they're not, I'm assuming you give them ways that they could fix things.
That's right.
All right, fantastic. So folks, there you have it. Sounds like a pretty comfortable meeting to me. Any arm twisting going on there, Larry?
No arm twisting.
Of course not. I didn't think there was. Again, if you want to visit with the guys, just pick up the phone. The number's on the screen. We'd love to see you in the office. Love to see if we can help you out. Welcome back. A few minutes ago on the show, during Chalk Talk, we were talking about effective diversification and how it goes a lot deeper than just asset allocation. Now, asset allocation was certainly part of the equation, but it wasn't all the equation. Well, now what I want to do is shed some more light on alternatives and how different alternative investments have the ability to really help with a portfolio make it less volatile and, more importantly, help protect you when the market goes crazy. So let's talk about this a little bit. So since 2000, so over the last 20 years, you have seen the stock market lose fully 50% of its value twice. Twice. In fact, during the early 2000s, during the dot-com crash, if you were in NASDAQ or technology companies, you saw that sector lose 80% over a 3-year period. So it's not unusual when you have big run-ups in the markets. It's not unusual to see significant drops that follow, and oftentimes 50% is certainly an outcome that we see. Now, of course, nobody knows when it's going to happen. So the key is we don't know when it's going to happen, so how do you design a portfolio that is effectively diversified so that when those times do occur, that you're not getting slammed? But at the same time, you also still want to make money, right? You still want to see your portfolio go up, so you don't want to just put everything in cash. I mean, good news, you put it in cash, you don't lose anything, but you also don't make anything, and that's really no good either. So the purpose of different types of alternatives is to essentially help you limit how much you lose when times are bad, but also still contribute to gains when times are good. That's the goal. And let me give you a little scenario that you might see from time to time. Let's go back to the concept of a balanced portfolio. A balanced portfolio being roughly half in the markets and half in fixed income or something. And let's imagine that we have one of those times when the market loses half of its value, 50%. Well, if the market goes down 50%, it affects the stock portion by, well, roughly that amount. Well, you only have half your money there, though. So let's do some numbers. Let's say you have 500,000, 250 in stocks, 250 in fixed income. And then the market, down it goes 50%. So it affects the 250 that you have in stock. That means you lose about 125,000 there. Usually when markets are going south, the bonds aren't doing so hot either. Usually they lose a little bit too. So let's say you lose maybe 10% there, 25,000. It's not uncommon during a big market drop, like say 2008. If you have 500,000, a balanced portfolio could lose 30% just like that. I mean, it's not an uncommon thing. Well, think about that. You started at 500, you lose 30, that means you lost maybe 150 over the course of maybe 1 or 2 years. Now you're at 350. Now think about what you have to do, because in order just to get back to where you started, you got to make 150,000, but you only have 350 left to work with. So it's probably going to take you, 3, 4, 5 years to get back to even. And that's before you can make any, that's just to get back to where you were. And then you got to try to grow from there. That's if you're not taking income. If you're taking income, well, the job's just that much harder. Now, compare that to a portfolio where you get some alternatives in the mix. Now, if you do this properly, the effect, and overall, effectively diversified, if you do it the right way, when markets go south 50%, instead of losing that 30% in the portfolio, maybe you lose 10, maybe 15. Well, now what happened? You start at 500, you lose 10 or 15. That's only 50, 75,000, which, hey, we still don't want to lose all that money, right? But you're still at 425, 450. It's a lot easier to get back to that 500. You get back a lot faster, even if you're taking income. So the net effect is this: what the benefit to you, how do these alternatives or different alternatives benefit you? They benefit you because they protect you from going south when times are bad, so that it's easier for you to get back to where you were and then move forward. Instead of taking 4, 5, 6 years to get back to even, it might only take you a couple. You get back faster, you grow faster, your retirement is just that much better. That's why you want to include alternatives, and it's really important you do it the right way. and that you have the proper mix, as we talked about earlier in the show. Hi, I'm here with Larry Flynn. He's one of the advisors at Centennial Wealth Advisory. And Larry, I know you and the other advisors, they do a lot of public discussions, a lot of public seminars on financial matters regarding retirement planning. Can you share with our viewers a little bit more about, what do you talk about, and what kinds of topics can they expect to hear you speak on?
Mike, we put on a 1-hour presentation, and I'll talk about a number of various topics, from taxes to the new fiduciary standard of care, just a number of things that we believe are critical in making somebody's retirement vision a reality.
So this is all about getting them good information in today's world on a variety of retirement topics. That's right. Now, a lot of these events, I know these folks are out there watching us right now. I know what they're thinking. They're thinking, Larry, I've been to these before, and usually it's really nothing more than someone trying to sell me something. Can you maybe respond to people that think about that?
Yeah, I'm really surprised by that. I hear that all the time. Hey, I went to these before. They hard sold me. They were trying to pressure me into making an appointment with them. That's not what we're about. Just want to give them some good information. If they see something from the presentation that they might want to hear more about, then great, we'd love to meet with them. But we're not going to meet with somebody that doesn't want to meet with us. We're not going to hard sell them into having to come to our office.
Yeah, why waste time chasing down people who don't want to talk to you anyway, right? Right. Well, that sounds great. So, Larry, I know you do these throughout all of northern Michigan. For those folks watching that think, hey, I'd like to attend that. Does it cost anything, by the way?
No cost.
So they're free. So they think, okay, it's free to go. I'd love to go, learn a little bit, maybe have a nice dinner. How do they find out more information, like when these events are and how to register? What do they need to do?
Well, they can call the number they've been seeing on the screen during the program. Okay. They can visit the website, www.sen-wealth.com.
All right.
Yep.
So website, phone number, either way, they can get all the information they need. Is that right?
There you go.
All right, there you go, folks. Sounds to me like it'd be worth your time to attend. You've got nothing to lose. And hey, maybe you'll find out some great information that helps you make your retirement better. Thanks, Larry.
Will your retirement vision be your retirement reality? Centennial Wealth Advisory invites you to an eye-opening and exciting event packed with up-to-date, valuable, and important information. Join us for a free presentation with complimentary gourmet dinner and find out what you're missing on these vital topics. What is the suitability versus fiduciary standard of care in the financial services industry? What are the biggest tax traps? What are the hidden costs in mutual funds? Why is getting a second opinion the most important financial decision of your life? And much more. Choose the date and location that works best for you. Thursday, July 13th at the Grand Traverse Resort in Acme, or Wednesday, July 26th at the Inn at Bay Harbor in Petoskey. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit sen-wealth.com to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, making your retirement vision a reality. Call 888-608-5825 today.
Hi, I'm here with Larry Flynn, one of the financial advisors at Centennial Wealth Advisory. Larry, thanks for joining us today.
No problem.
So this week, we are talking about diversification, effective diversification. Sure. And, we're getting towards the end of the show here. We're talking about client stories. It's that time. Mm-hmm. So you're out there in the field. People call the show. They visit with you a lot of times and the other guys. There's got to be something that you're thinking of when this topic comes up.
Yeah. Oh, Mike, I'll never forget. It was late 90s. Okay, markets are screaming, right? And .com and the stocks thereof are real big, right? And I get the client comes in, he says, oh, I just got a lead on, 2 big .com stocks, and Larry, I want everything to go into these. And I'm like, got to sit them down and say, now listen, there's no earnings here, right? But,
Yeah, because those .coms, they never had any earnings.
They never had any earnings. I said, maybe it would make sense. Maybe we just don't put all our eggs in one basket. How about we put maybe 10% in it, if you think so highly of them, but let's just do 10%, right? Well, it wasn't a year later, the tech bubble burst, right? Those 2 .com stocks, worthless.
Worthless.
Had I let him do that, he would have lost everything. To this day, he thanks me for not having it.
Wow. That reminds me, I had a gal in the same time frame. She thought she was diversified because she had 40 different positions in her portfolio. And, at first glance, it looks pretty good. But then you find, oh, wait a minute, all 40 of them were tech companies.
That's right.
And she ended up losing 80% over the course of that tech crash right there.
Right.
Yeah, so that comes to mind. What else comes to mind when you think about diversification?
Well, the big one is '08. I can't tell you how many people I saw when real estate was doing so well decided that, Larry, I don't want my investments. I want to put it over here into real estate because it's so hot. And they took everything and again put it all in one basket. And we saw what happened there. We got the credit crash, right? And real estate
and that
dropped
went
to all
crazy.
time lows. Oh yeah.
See, the other thing I think about, and tell me if you see this too, don't you have people that come into the office, they watch the show, they come in and visit with you, and they bring you their portfolio and they think that they are diversified.
Sure.
Right? They think they're diversified because they see all these different funds and, stocks, bonds, everything. But when it all comes down to it, I mean, it's almost like they're basically holding the S&P 500. They could put all their money in one position, Vanguard, and have Vanguard S&P 500 and have about the same fund, same thing. Is that?
Right.
Would you say that's fair to
Right.
say?
Yeah. What they don't recognize is they think of diversification as a number in that asset class. But most things within an asset class all go down together. I mean, we call this systematic risk, don't we? But
Right.
in '08, all large cap funds and S&P 500 all went down at the same rate, right?
Yeah, you could have had 3 or 4 of them, but they're all going down, aren't
That's
they?
right. That's right.
Larry, I appreciate you. It's really good information this week. Thank you for joining us. And folks, by the way, if you're sitting there and you think you're diversified, hey, doesn't hurt to get a second set of eyes on your situation, does it, Larry?
That's right.
Call the number on the screen. Come visit with us. Let us help you double check that you truly are diversified versus just thinking you're diversified. That's our show for the week. It's been a great show. Thanks for watching. Remember, you only retire once. Let's make sure you do it right the first time. We'll see you next week.